Welcome to week 40 of Math.Logic.Wealth. I'm Cait. This week, corporate needs analysis. Most life insurance advisors are trained on different approaches to selling corporate life insurance, and they say, go sell. And a lot of it's backwards. Here's what business owners should know before any of us start to position products. The question really this week is, where do we start? And the answer is, how can I help? Our role. Life insurance doesn't come first. It comes last. Structure follows strategy. Foundation first. Preparing for exit from the corporation, valuation, tax strategies, retirement alternatives. It's only then that we figure out where life insurance fits. The problem is we get paid for selling. We get paid for selling life insurance, and we have a compromised impartiality. The solution is to acknowledge it, to work around it, to take a more sophisticated approach. And here's what it looks like. Now, the top box, the broad concept, that's our primary role at the beginning. We can be the catalyst. We can talk about the importance of planning. Broad means covering a large number and wide scope of subject or areas. And at the end of the day, we have a specialty. It's called estate planning with life insurance. We don't sell anything except maybe some inexpensive convertible term to protect insurability until it's our time to consider the permanent life insurance product options. The bottom line, the traditional approach in this graph, I'm not a fan. It's sales technique, it's illustrations that may or may not be appropriate. Where we live, where professionals should live, is in the middle section, what I call the benchmark approach. Your responsibility when the time comes is to use this section and ask, compared to what? How does the life insurance fit? Can you please put everything in writing? The foundation comes first. It involves other specialists. We contribute if we can, but then life insurance decision tree. We fully armed with the benchmark approach. The next slides show why we can afford to be patient. It's then that we show the math, verifiable data, not projections, but at the right time after the foundation is established. And we can afford to be patient. It works because last year we provided the product fits. We showed 5 different corporate applications for the buy-sell, for estate bond, for corporate insurance retirement program. We went through buy term and invest the difference. We addressed immediate financing approach. Math works. The results reflect the skill of the independent life insurance sales professional in the corporate market. But the problem is we forgot to stop selling. We proved that insurance fits. We didn't prove it should come first. Foundation first, then our work. And here's an example of the proof that it works. Here's a corporate estate bond. Traditional approach, double tax, insured approach, tax advantage transfer. The product works. We proved it. But proving product doesn't work, and it doesn't mean it comes first. Business planning, how to maximize the business value, tax planning, retirement alternatives come first. Here's what comes before our work. Things like IPP. There's the first foundational issue. The first of the 3 transitions I'm sharing today from salesperson to trusted advisor. First, the individual pension plans. Shareholders have limited resources. Alternative options exist. IPP is one. For retirement funding, pension specialists often serve consumers' needs better than we do with our life insurance. Hand the sale to another professional or become proficient yourself. But not sharing this option, not professional. Different objectives, different tools. Let the consumer choose with full information. Here's a chart. Compares IPP to corporate life insurance. IPP funds retirement, tax deductible, builds pension income. Insurance funds the estate transfer, after-tax dollars, tax-free death benefit, capital dividend account. Different objectives, different tools. Hand this to their financial planner because your role, provide the comparison. The next issue I'd like to address is the lifetime capital gains exemption. It comes before the insurance sale. It's a structural issue. This comes before anything else in the process. Accountants determine qualification. Lawyers handle documentation. We coordinate insurance within their strategy. This leads to tax optimization. We might coordinate policy transfers to their holdco and assist in the process, but here's what you're responsible for when it comes about knowing about the lifetime capital gains exemption. This is it, capital gains deduction from CRA website. You should know that 1.25 million of taxable gain on any disposition, whether it's at death or on sale, is available but only if the business is structured appropriately. You can multiply it between family members, sufficient value when you know what you're doing. The accountant does that work. He does the qualification. He measures safe income. He looks at the structural design. The lawyer does work, documentation, timing, audit survival. Our work, maybe coordinate policy transfer supporting their purification process. This is a structural construction issue that comes before product sale. And here's the next issue, business planning. This is the third issue in our foundational series. We want the business to know that the business itself is the most important asset and the most important decisions are made around the business. The critical decision, who should lead the planning? We have Sean Kavanaugh in our group. Sean is a valued member of our group that meets with us each week for the last 2 years. He specializes in preparing businesses for sale to get the maximum value. Shouldn't we, as professionals, be offering him to business owners who are thinking about exit strategies from their business? Or maybe I should say, I'll try. I know business stuff, but am I good enough? Am I qualified? No, but I'll try if the client asks me to help. My advice, get the best conductor you can afford. Specialists should drive the train. Business planning creates the value. Tax strategy optimizes it. We coordinate insurance within both. And here's why. Business planning comes first because it's about goal setting and strategy. It's about securing maximum value, operational guidance towards sale readiness, risk mitigation, improve focus, work on the business, not in it. This creates the wealth. Our insurance supports purification after value is maximized, but you still need to get the specialist who creates the most value, and that's not us. Then we coordinate insurance within their strategy. 5 foundations before positioning products. Our benchmark analysis, not illustrations. Foundation with specialists before evaluating if insurance fits. And we acknowledge the IPP when it serves retirement better. Alternative options exist. We let the accountants and the lawyers lead the lifetime capital gains exemption process. What we can do is coordinate within their structure. And the business planning specialists, they come first. People like Sean Kavanaugh, they create the value. We put everything in writing. We transfer control back to the consumer, and the life insurance comes last. Structure follows strategy. And I say to you guys, stop selling, start helping. Show me that you understand professional responsibility. That's Math.Logic.Wealth way. And thanks for joining us this week, and I'll see you next week.